Joining us at Post 9, Deutsche Bank Chief International Strategist Alan Ruskin and Invesco Global Market Strategist Brian Levitt. How are you explaining, Alan, the yield curve inversions across the curve to your clients?
No, I think you hit the nail on the head to some extent. I think the global backdrop is usually bullish. I think there's just a rush for yield. I think people ultimately think that most central banks are going down to zero. Some are already negative. The Fed is perceived in the longer term, I think, as potentially going down to zero as well. That's not an awful lot of stimulus in the package there. So I think people are just looking for duration and looking for yield, and it's a global phenomenon.
I am not going to be one of the guests that David predicted he would have on the show today. It's an ominous sign. And cycles end with policy mistakes and inversions of yield curves. Now, just because the yield curve has inverted 4 to 5 basis points doesn't mean that this cycle has to necessarily end. But what it does mean is we need greater clarity on policy. Now, the usual cycles end, to Michael's point, with the Fed raising short-term interest rates above the 10-year. This time is different. The Fed is in an easing cycle, but as long as the uncertainty persists around trade and as long as business sentiment, business investment, new orders all slow, the 10-year is going to go along with that. So what do we need here? We need the Fed to cut interest rates further, and we need clarity from the administration. It doesn't mean we need a trade deal tomorrow, but we can't keep going on with businesses not understanding the rules of the game, because if businesses don't understand the rules of the game, it's very hard to put investment into place. And without investment into place, growth slows and yields go further.
We're seeing that. So are those the policy mistakes you're referring to, or are you expecting further mistakes?
No, these are the policy mistakes that I'm referring to. I mean, look, the Fed made a policy mistake last year, raising interest rates 3 times in what was still a largely slow growth, disinflationary world. They're backing off of that mistake. The administration, regardless of what they want the ultimate outcome to be, needs to at least provide some clarity to the market. So protectionism, we all know, leads to inefficient economic outcomes, but it doesn't mean it's necessarily recessionary. It's when there's uncertainty that persists for a long time where you could really end up with a strong dollar, weaker earnings, and dare we say even a recession. I don't think we're going to go there in election year. I actually think the administration is going to work to try and put a bottom in here and try to get rates back up again. But the risks are rising to this cycle.